Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Market prices are impacted by a host of forces, including changes in the economy, in earnings, and in the stance of monetary policy. For Andy Constan, flows carry great import as well. Hitching a ride to Wall Street in 1986 at Salomon Brothers, Andy was part of a group that contributed to the Brady Commission Report, the post-mortem on the calamity that was the '87 stock market crash. In this context, he shares his views on episodes in which flows into or out of an asset disrupted the equilibrium of supply and demand, leading to shocking movements in price. Among them, Andy describes the April 2020 negative price in front-month crude, a short-lived but intense dislocation resulting from mechanical ETF flows. In furthering the discussion on liquidity, we explore the blowup in the long-dated S&P variance swap market in 2010, a trade that Andy ranks among the most attractive he has seen in his career, a result of an extreme imbalance in supply and demand. Our conversation then shifts to the present day of risk and the work that Andy is doing at Damp Spring Advisors, a research firm he founded in 2019. On his mind is the market's capacity to adjust to a regime of higher rates, the factors that may leave QT more or less impactful, and whether Fed policy ultimately leaves money tight or not. I hope you enjoy this episode of the Alpha Exchange, my conversation with Andy Constan. My guest today on the Alpha Exchange is Andy Constan. He is the founder of Damp Spring Advisors and a gentleman with a long track record on the business of both the buy side and the sell side. Andy, it's great to reconnect and have you as a guest on the podcast today.
Dean, thanks so much for having me. I'm really looking forward to this conversation.
We obviously share a fair amount of similar DNA just in terms of the equity derivative side of the business. So I figured we could do some history. You've got many, many years of tenure in the markets, and it'll be great to get some of your rendering of change over time in terms of how business is conducted. We'll talk about some historical risk events. Love to get your assessment of the here and now, and then love to hear more about the focus of Damp Spring. We'll have no problem filling up an hour here. Let's get it underway. Let's learn a little bit more about your early days in the business. Tell us about how you got your start and maybe about a couple of meaningful early experiences in terms of being on the sell side.
There are two ways I'd break up my career, just to give you some context. There's the what I would call relative value world and the macro. And those have been two phases of my career. And then there's the sell side, the buy side breakup, and those two differences. And those are the way I frame out my career. But starting at the beginning, I joined Salomon Brothers in 1986 as a corporate finance analyst, really not knowing much about Wall Street, just being an engineer by training, so fairly quantitative, and fell into something I really loved. And that, my good fortune, the world's bad fortune, the stock market crashed in 1987, and I had a transformative experience being asked to represent Salomon Brothers on the Brady Commission, which investigated why the stock market crashed in 1987, what the market mechanisms that caused such a rapid fall in the markets. And that really got me involved in understanding how various people in the markets and the way they participate in the markets, their flow, their positioning, their strategies, interact with available liquidity and set prices. And that really set off my career as first as a market maker in the convertible bond department at Salomon and a prop trader there. And then similarly in the equity derivatives in the United States and globally, before I moved on to the buy side.
I had not known that you were part of Salomon Brothers representation in terms of the research that went into the Brady Commission. That really was my start as well in some ways, because I was in college and I had a chance to write a senior thesis and I chose it to be on the stock market crash. So I, of course, came across the Brady Commission Report. I like to say anytime there's an event of enough consequence in markets, there's going to be a government-sponsored report. Post LTCM, post the GFC, post the Amaranth nat gas blowup, there was always something coming from one of the regulators or the government itself.
I think this really did a great job. It was very practical. It certainly painted a picture of the macro, but it was very practical on why so fast, what happened mechanically over the days from October 15th through the end of the following week, which included the 19th and the 20th, which were the big events. It was very practical. You look back at the report, the graph that I built on Lotus Symphony, the upgrade from Lotus 1, 2, 3, which never really took off, sitting in Jerry Corrigan's office, sequestered with 4 or 5 other guys from Wall Street trying to go through exactly what happened, still live and still tell a real lesson about what can happen when markets disconnect.
It really is one of these lessons around just, I think, as you referenced, the force of flows. And when you get mechanical flows that are in most ways price agnostic, and if they're big enough, they can overwhelm the liquidity available in the marketplace. And as I kind of dug into that, it was just so interesting that this Leland O'Brien Rubenstein mechanism had so much take up from the pension community that comprised the S&P. Let's just jump around a little bit and ask, is there an equivalent? I know of one event that I think is an equivalent. I like to use the term keyhole effect. If everybody's trying to get through that at the same time, there's really going to be a jam. And the only way to satisfy the jam is really price. Are there other instances in which a derivative or a trading strategy overlaid on the market just overwhelmed the ability for the market's capacity?
Most recently, the one that sticks out in my mind is the need for an ETF to roll its oil forwards in April and May and June of 2020, which generated a negative price for the first time ever, negative price for an oil future.
It's a great example. I was thinking about the VIX implosion in Feb of 18.
Of course, absolutely. Armageddon. And that was clearly one in which there was no market available for the necessary demand. I would say that the most specifically exactly the same and unforeseen at some level by the Brady Commission similarity was literally the flash crash, which was catalyzed by troubles in Europe, but resulted in a 10% move down in the stock market. And this is where the Brady Commission missed it, a 90% move down in stocks like Procter & Gamble, simply because Waddell and Reed used an LOR form of portfolio insurance and their algorithm didn't have the necessary controls in it. And so they just kept selling baskets of stocks when there was no bids.
I think the part of that has always continued to trouble me is it's one thing for an execution engine to just be so large. And like you said, it happened at a destabilized time already.
Well, that's when it matters.
Exactly. Yeah. So you have an already vulnerable market. Why Procter & Gamble went down to $1 or 10 cents or whatever that was, I'm still troubled by that. And I think about that as a bit more of a market structure issue. That one's a hard one to explain.
Yeah, I mean, I think that's the negative of having a no specialist system in the United States. When you have primarily electronic market makers who their own algorithms are programmed to widen or eliminate widen the bid offer spread on increased vol, whatever measure they're using to say today is a day when we need to be rewarded with wider spreads, to turning off the machines when they literally don't have any sense of what's happening. That just removes the idea that if there was a specialist, and I'm not advocating for specialists, monopolies are bad, but advocating when there was a human being that was able to slow the market down, that stock would never have traded down there.
And there was a similar, certainly not as pronounced, but the up crash in terms of Treasury bond prices. I'm going to put it in October of 2014, which was the Treasury crash, which probably was precipitated by some wrong way risk where someone needed to unwind something in a hurry. But by all counts, it just got considerably quicker and to a larger degree in terms of what you would want from price discovery in the risk-free asset. And there was a lot pointed to back then in the aftermath of the electronification of liquidity. We live in this incredibly electronified world of liquidity. And what you just pointed to, and where I'd love for you to weigh in, is this idea that if I'm a machine, I'm not reading the newspaper. I don't really know what's going on. I'm fast. I've got math behind me, and I can move very quickly. And I think one of the questions people often cite as a almost systemic risk is that enough of these machines that provide electronic liquidity are kind of built on the same thing. They have a similar risk tolerance. Like you said, they react to a withdrawal of liquidity. And by doing so, they worsen the withdrawal of liquidity potentially at the same time. How does that hit you in the context of today's markets?
With a simple Sharpe ratio, these machines, obviously it's much more complicated than this, but the concept is simple. Your reward for providing temporary liquidity is equal to your risk. When the risk goes up, you need more reward. That's it. Everything else is sort of secondary. That's the concept. And these machines have that. The thing that I want to step back, though, is it's important to distinguish between temporary liquidity events and what that means to markets and the real providers of liquidity. The real providers of liquidity are long-term savers. And with enough incentive, they provide liquidity. So the temporary liquidity providers are ones that, whether it's the old-fashioned block trader or the new-fashioned high-frequency trading algo out of Renaissance, that's or Citadel that's doing payment for order flow, they're all providing immediate execution for people who want out right now, and they get rewarded for it by replacing that to people who either want to get right in right now, later, or are long-term liquidity investors who just take a little time before they buy. I don't believe that the electronification of short-term liquidity providing has damaged the process of finding long-term liquidity. And so you have to balance whether these episodes of short-term spikes versus all of the other benefits of narrow bid-offer spreads, very quick time to execution for a majority of liquidity, of every day's liquidity, but really a majority of most end investors' needs, which have been great and have been the democratization of finance that have allowed a broader range of people to participate, versus this idea that you can occasionally have a machine break like that. And it's not a machine, it's, as you said, the market mechanism. Knowing that the real liquidity providers ultimately do step into markets. The negative about more frequent breakdowns of the ones we've just described due to the electronification issue is that long-term liquidity providers may need higher returns to provide long-term liquidity to invest, which can hurt overall asset prices. But that tends to be, these events happen and then they get forgotten. And so it's an interesting dilemma. I'm not sure there's any sort of right or wrong solution. I, by and large, like the idea that we can trade 99.9% of the time with narrow time of trade, bid-offer spread, and high liquidity. But the downside is that when it goes bad, it tends to go bad worse than it did when there were humans slowing the process down.
Well, over the course of our chat here, I think we'll certainly weave in many episodes of crisis or market dislocation. I find there's a ton to learn from that. And we started with the 87 crash. In some ways, that's the granddaddy of them all, at least for one day. And then you traded all through the 90s. You were at Salomon through LTCM, I think, through the 94 bond market massacre. Walk us through those early days, let's just say pre-tech bubble, in terms of some of the events that colored your risk philosophy, some of the things that really stayed with you, or some war stories from the risk management front.
I joined the convertible bond trading desk in 1988, and I had authored with another quant in an equity unit a convertible bond pricing model. And when I joined the desk, the head trader asked me to calculate the yield of a particular bond. And so I brought out my HP12C and put on the price and got the yield to maturity and gave back the yield to him. And he said, "No, you idiot." I said again, and it was that. And he said, "No, divide the coupon by the price." And so that was what's called the current yield, which is a relevant statistic. I'm not saying it's not true. He was right, I was wrong. But it made me realize that the concept of valuing a convertible bond when your starting point is calculating the current yield instead of the yield to maturity meant that the convertible bond market probably had a fair degree of misvaluation. And so that was very exciting to me for obvious reasons. And for the next 7 years, I sort of, with a couple of guys at Morgan Stanley, Vikram Pandit in particular, the traders over at Morgan Stanley, some Goldman guys, and a couple of major convertible bond hedge funds, really started changing the way convertible bond valuations were priced and building large inventories of bonds and making a ton of money while doing it. And that led to a lot of innovation in convertible bond issuance, who issued, and so on. But you come to 94, this was my first lesson why macro matters to relative value far more than most relative value traders still, even to this day, appreciate it. And yet that lesson gets told year after year after year. In 94, Greenspan decided to raise interest rates, 94, 95, started to raise interest rates to deal with the increasing inflation associated with the economic recovery post the 90-91 recession. And that resulted in a fairly major blow up in what had become a very complex mortgage business. If I remember correctly, levered IOs were the flavor of the crisis that was at the center of these things. And their lengthening duration and high convexity, I believe it was levered IOs, it resulted in major losses on the street, major losses in hedge funds, and major losses across fixed income, including the Orange County Pension Fund taking a massive hit. And so we all saw that going on, and we're looking at our convertible bond prices, and they were doing just fine and all that. And then the multi-strategy hedge fund redemption phase kicked in. Those with mortgage arb in their portfolios of hedge fund strategies started redeeming their mortgage portfolio. The fund of funds that owned a mortgage hedge fund got redemptions from its end client, and that pushed risk arb and convertible bond arb and credit arbitrage and government bond arbitrage relationships all out of whack, as the fund of funds had to not only just redeem its mortgage book, but also had to redeem its other investments. And so hedge funds, assets under management, leverage, the entire hedge fund industry got delevered, and they were major holders of convertible bonds. And I had my worst year in my career in 1995 because of that one event. And it had very little to do with convertibles. It had everything to do with Greenspan fueling a global unwind of hedged relative value positioning.
It's a fascinating one because of what we're in now. And it's almost as if Greenspan, in one fell swoop, he sort of broke an implicit promise. I mean, the Fed was very different back then. It was not the coddler that it had become, at least up until 6 months ago, which maybe it's a kick gloves are off these days, but it introduced a lot of uncertainty on the rate side and the rate vol side. As you note, I'm actually looking at right here, I developed a derivatives blow-up Hall of Fame, and I've got 9 players on it, and Robert Citron is there from 1994. And I just would like to read from this card here. It says, Citron relied on a $4.50 star chart prepared by a mail-order astrologer from Indiana for interest rate predictions. So he was the wonderkind of the time. And as you said, he had so much duration through these IO structures. It was unbelievable.
I think he had a 4 squared investment and somehow.
He did. The leveraged inverse floater was his trade. What's interesting is you point to having positions on that effectively are in the line of fire for other positions that get delevered.
I always thought when I was trading RV, I was trading alpha. I was taking money from convertible bond issuers who would issue too cheaply and arbitrage it against equity people who would pay a fair price for the equity delta and fixed income people who would pay the fair price for the corporate bond. and I would manage the volatility risk, which I thought I owned cheaply, and that was my edge. And I think every RV relationship, relative vol ARB, off the run versus on the run treasury ARB, corporate bonds hedged with CDS to create either a positive or negative carry, depending on which way that market is leaning, all are examples of relative value trading strategies in which, when you look at their returns through time, you will see, and this is the lessons I've learned over, I'll mention the time periods, 94, 98, 2001, 2004, and 2008, and possibly for the last decade in the long-short business of stocks. That alpha is extremely vulnerable to those who provide leverage to the system. And whether that's a central bank or a banking system, when they withdraw leverage, relative vol trades all cheapen as one. And when they provide leverage, all relative vol trades richen as one. And it makes me think, and the alpha is always in market timing, but if you are career to date long convertible bonds as a relative value trades, and you're always in them, and you never market time them to have zero inventory or to have full inventory, chances are you're going to have experienced drawdowns, significant drawdowns that take a significant portion of your total P&L in 94, 98, 2001, 2004, and 2008. And your returns, you might as well have done something stupid, like just owning risk assets in a diversified way, and you would have done just as well, if not better, at certainly lower transaction costs. And so that's the lesson. Is it true? There's a million different cases of people managing that exposure properly and persisting with alpha through time. But I think what they did is they predicted the macro. They predicted the removal and addition of the ability to lever up positions correctly. And that's their edge, not what they ended up investing in from a relative value standpoint.
I think an example that comes to mind is the Nikkei S&P variance swap spread trade, a very successful construction for quite some time. It has some structural element to it that you might argue that one market is undersupplied from a vol standpoint, another is oversupplied. The back tests look great. It tends to hold up through a bunch of different cycles.
I had that trade on at Arceus from 2003 to 2007. It made the most money I've ever made in terms of return on investment of any trade I've ever done, and stopped looking at it once I went to macro.
That was good. It certainly has suffered some pretty unbelievable drawdowns.
2008 was a good example of that trade not working.
Yeah, I think one part is just the crowdedness of it, that there's so many people leaning into some version of short vol and short skew in the S&P that as deep as that market is, to buy it back is going to cause a fair amount of dislocation just given how many people are in it. And the other thing that happened, which was just, we only know the data that we've seen so far. So, and I want to get your take on just how back tests and data makes its way into your process. But one of the things that came out of this pandemic in terms of the market reaction was the S&P actually outrealized the Nikkei over the course of a month by 25 vols.
Wow.
People who had this trade on for very small size really regretted it. I mean, 25 vols is just, it's off the charts in terms of standard deviation. It's nothing that the data series ever prepared us for. How does that make its way into your process in terms of looking at these trades and trying to develop some edge and a feeling like you've got something that is going to work well prospectively, but also knowing that the past doesn't necessarily predict the future? It's instructive, but not necessarily something we want to rely too much on. What's that balance look like for you?
Great jumping off point to my experience at Bridgewater, and a couple of very good stories about that specific case in terms of equity vol. So I took the Nikkei S&P spread trade on my first interview with Bridgewater and sat down with Greg Jensen and Karen Carnell-Tombar, who were CIOs there. Bob Prince, who's the CIO. I didn't meet Ray yet. And I laid out why I thought this was all of the reasons, even at a macro level, why this was a good trade, a good thing to monitor in vol space, because that's where I was likely to spend my time helping Bridgewater, is they had no real experience in vol. And I showed them my back history, my back tests. I had used data back to the first index option that ever traded and realized 35 years. And Greg said to me and said, this is nowhere near adequate back history. And even today, I look at sophisticated hedge funds who will look at 5 years of back history as a relevant horizon. And I thought I was doing a great job at 35 years. And frankly, hadn't conceived, and this was my limitation, hadn't conceived of the idea that you could actually look at back history before options ever existed. Later in my time at Bridgewater, I actually worked on a project where I had to create a back history of implied vol. And obviously, that's a complex thing. For one, you'll find, I think you probably agree with this, that implied vol tends to be coincident with realized vol and predictive of neither. So that's tough to model. But you can use realized vol as a fairly decent thing for implied vol if you look at a back history, because they tend to be coincident. So the question is, what's the premium? Anyway, we had some interesting discussions to come up with a back history, and we ended up using that to determine if systematic put purchasing is a smart strategy for long-only funds to have. Our conclusion was that it gives away too much of the risk premium that you get because of things like skew. But anyway, it was an interesting discussion to think that 35 years was enough. So then I joined a few months later, and the flash crash happened 3 days later. And I don't remember if you remember the timing of this. Subsequent to the flash crash, the 10-year point in SPX vol went from the low 20s to 38 in variance terms. So why is 10-year vol bid up to begin with? Who has any interest in 10-year vol? The answer to that is there, for most of the 2000s, there had been, and even going back to why Larry Hillenbrand sold variance in the SPX and global indices at LTCM, insurance companies in the United States had packaged annuities, life insurance policies, with investments, which were essentially long calls on equity indices. And because life insurance policies are long, the life insurance call option was 10 years in maturity. And so that demand started ratcheting up the back end of the curve. The first seller of that was the UBS structured product desk, which blew up in the 94, 95 timeframe, 96 maybe. And then Larry decided to take the other side at LTCM and ended up with, I think, 100 million Vega at peak at LTCM, which he then had to cover. And then after the stock market fell in the 2001-2 time period, Warren Buffett decided to come in and take the opposite side of some of that exposure. And from 2004 to, I think, about 2007, possibly some more in 2008, he sold, and he famously said this, I think it was while he was selling in 2008, he famously said that he's being paid, I don't know, 6% premium to sell out of the money puts on the S&P, that he'll want to buy if the stock falls there, and otherwise he gets the 6% for free. And the collateral terms for him selling these puts turned out to be very attractive. The buyers of the puts didn't require any collateral. So Warren got this great deal. And at one point he had $250 billion of notional puts on, I believe that was the right number. It was a huge number, not 250, a huge number. That's right. It was 250 million of Vega that he had sold. The notional was smaller than I mentioned. Anyway, he had sold these puts, and then the flash crash happened, and he decided he didn't want to own as many of them. It'd be short as many of them as he was. And he squeezed Goldman, who squeezed the market. There was no UBS, there was no Larry Hillenbrand, there was no Warren Buffett. There was no one. And so up to 38 vol went for 10 years. And so this comes back to the track record thinking, what timing. I sat with Bob and Greg and Ray and laid out what the carnage had been. And remember, this was 2010, so there were still lots and lots of unusual things happening post-crisis. Mortgages were still ridiculously cheap. Credit was still very, very cheap. And we looked at the vol, and the project I was asked to do was to really get a complete supply and demand of all vol product globally in this tenor, how it was being handled, and then to look at every single stock market that has ever existed back to 1785 in the UK and the 1880s in the United States, as late as 1991 in Russia, and look at every single and every emerging market you can think of, every piece of data, every stock market piece of data that you can have, and determine how many times 38 vol has been realized for 10 years. And the answer to that is only twice. Only Germany and Japan when they went to war against the United States and the Allies. And so we looked at that and said, well, that's a significant statistical relationship. Selling 38 vol looks like a very, very good trade. But we went further than that, and I had, and this is where flow and positioning comes in, the National Association of Insurance Companies actually has by far the most interesting data set in terms of flow of any I know. And that's because on a weekly basis, all insurance companies in the United States report every single trade they've done and every single trade they own at the level of terms of a variance swap and who the counterparty is and its expiration, as well as options, swaps, anything you can think of is reported. And so I was able to count exactly how much product they had sold to their end clients through the insurance companies and hedges they had purchased, laid off obviously to Warren in terms of him being the ultimate source of the vol, but also being able to determine what Goldman's position was, what Deutsche Bank's position was against these counterparties. And so I had a complete picture of where the vol was, who had it, what they typically did with it from a dynamic hedging standpoint or not. And with that, we had what I think was probably the best trade I've ever seen in my career, as deeply researched, both in terms of a historical basis and a who's in what trade and what's the risks of those trades.
That's the part I remember quite well. In fact, I just pulled up an old piece that I had written, and it basically was on Buffett and effectively his ability to really ignore the reality of mark-to-markets. There was a research piece put out where they actually derive what Berkshire's vol inputs had to have been, just given how they were valuing the equity puts.
Oh, yeah, he lied completely.
Yeah, they stuck him at between 21 and 23.
That's exactly the number, exactly right.
Yeah, and so what was fascinating, Andy, about that period was, I have another chart here. I got some broker estimates. This is back in July of 2010, and the variance swap curve, so the term structure of variance swaps, was upward sloping. DEIS was 31, and that was DEIS 2010. DEIS 19 was 37, and like you said, got to 38. It was remarkable. Now, here's where I want to go with this, because you do all this research, but the reality is something doesn't get to 38 unless something has gone god-awful wrong for all those counterparties that would have stepped in, tried to step in at 27, 29. The thing about vol is you average in, and then suddenly if it's not working, you're going to buy it at any price to get out. That's selling index vol. This was Goldman's top trade of the year, shorting forward starting S&P variance. And so clearly you get to 38, and by getting there, it means you could get to 45. It means you could get to 50. That's just a fragile, broken market. And that's my question is how, you guys did a ton of research on it. You want to feel like you're alongside some steadier hands. How did you get comfortable with that. The price is appetizing as all heck, but how do you get comfortable with the mark-to-market risk?
Best trade I've ever identified in my career, and Bridgewater didn't do it. And the realized was sub 20 for the term of trade. And the reason why Bridgewater didn't do it is because it wasn't that it wasn't a convincing argument. It was that it was a trade. And in order to do a trade, so Bridgewater doesn't want trades. It wants alpha streams. A trade is a trade. An alpha stream is being able to do a trade every day. And so for them to invest in a trade and then have it work, and it would have worked great for them. They would have made 5 vols in the first year and 13 vols over the next 9 years. But that wasn't what their business is. Their business is constructing 35 to 40-year alpha streams that they can use every day. And they just ran out of time. They didn't have the interest in pursuing the trade. That's a huge lesson to me, because a lot of Wall Street looks for the trade and doesn't build their long-term business. And so that's the Bridgewater story. But Bridgewater was a good example of and I think this is what happens, deep pockets of liquidity that are capable of doing the analysis and getting comfortable end up stemming that tide. And in this case, I believe the counterparty was Hoops, which is a sophisticated pension fund in Canada, who ended up being the seller that provided the 38 vol. And they lived with it. They had done the work and they lived with it. And they knew what you said is true.
Well, it's funny. I was just going to say, I remember the time so well because I was actively engaged in helping one counterparty put the trade on. But what we decided to do was to use an option on realized variance, which was incredibly expensive. It was about 6 vols. You're paying away that. But it was viewed as insurance that was just worth it, just given how high the strike was, that you could even get away with paying 6 vols.
32 strike for 6 vols or something?
Yeah.
34 strike. Well, yeah, that's my thinking, that there is this pool of liquidity out there that can multitask and take up that type of trade. And what I'd say, again, coming back to the high level point, which is that needs to be an unlevered fund, because the reason why 38 goes to 45 is because of leverage.
Exactly. Well, a lot of this conversation is around market prices and interacting with market prices, perhaps providing liquidity where others aren't willing to. That would seem to be some version of selling index vol and gathering the VRP over time, trying to risk manage the VRP. You talked about your early days in convertible bond. I know that product has evolved and gotten more competitive, but in the early days, it might have been a corporate that's monetizing vol and maybe leaving some of it on the table. They're not vol traders in the way that folks like you were. Maybe dividend swaps fall into that category where there's something structural that's just left on the table in terms of people wanting to risk manage their long dated books. Walk us through that just in terms of how you think about those types of, I wouldn't call them inefficiencies, but maybe they're structural pricings that can be attractive for sophisticated counterparties.
Yeah, I think that's, again, just another form of beta. Owning dividends is another form of beta. It happens to be highly illiquid, subject to the only people that own it are the wise guys and the people who sold it to you, and they own more than you could ever want. So where do dividend swaps arise from? Dividend swaps arise because when you trade a call or a put, you can't lock in the forward dividend. So you are either, depending on what you've traded with your counterparty, who has an interest in owning an option. And in the case of dividend swaps, it's largely those who have done structured products in Europe. And that's why that market sort of originated there, as I recall. And places like SocGen, who were the biggest providers of that type of product, ended up long a lot of dividends and knew that they would have higher P&L if their dividends went up and lower P&L if the dividends went down. And their end client had no idea that they had that exposure. But now they have too much of it. And so they look to the first thing they want. The first thing that happens is they get a call from their P&L guys and say, how do we mark this option? We don't know what the dividends are. And they say, well, use these. And then that's fine for a while. And then the P&L guys get audited and wait, you took the trader's input? Can you get a market price? And then the risk manager says, wait, we have market risk on these dividends? And so they say, well, what's the market and what's the volatility around that? And then SocGen says, maybe I can sell some of these and realize a high P&L because I'm selling them still at a premium to where I bought them, but at a big enough discount that a wise guy will want some of it. And so they do. And now you have dividend swaps and dividend futures. And the end SocGen, or the manufacturer of the structured product, still has more than they could ever imagine they could ever dump. And so they're never cheap. They're never rich. And sometimes SocGen, for whatever reason, pressures in the financial crisis is a good example, needs to get rid of more. And there's nobody that wants them because all those guys are like, wait, I want to get these sold too because I'm getting a redemption. And you have this beta impact of a deleveraging of the dividend swap market. And so I've done lots of work with real investors who know that dividend swaps are essentially a small delta of a stock. Not all of the stock's price, but small delta of a stock. And they should be indifferent between buying a dividend swap and buying the S&P 500 and buying an S&P 500 future or any sort of product because it's just beta and it's cheaper. But these products don't catch on with end investors enough to create any sort of demand that is close to the supply. And so I think the market just evolves that way and has evolved and continues to be an opportunistically cheap sort of thing, but you're going to lose money on it when all your other relative value trades or wise guy levered RV stuff cheapens because a deleveraging is happening.
Let's shift to the here and now. We've got a pretty fascinating set of prices that we stare at these days. Inflation, rate vol, obviously the whole crypto universe is a unique thing. People complain that the VIX isn't high enough, it's not reactive enough. So let's start with your founding of Damp Spring. Tell us a little bit about the effort and what you're working on behalf of your clients. And then as part of that, we'll shift to just some of your assessment of opportunity and risk in the present day. Tell us to start about Damp Spring.
Sure. Well, Damp Spring is a research company. It was founded with the help of my prior employer, Brevin Howard, who was interested in outsourcing my work and also allowed me to contact other hedge funds and investors to provide them research. And what I do is similar to what I've described to you, which is I look at the macro drivers for investing across the world. And those drivers are the traditional, which are changes in expectations of growth and inflation. And what I think are the two more important ones, particularly lately, the amount of risk premium available to beta investors and how that changes through time, and the flow and positioning of all sets of investors and how that changes through time. And with those four pillars, I evaluate for my clients, my broad range of clients, investment opportunities in the global macro markets. And my research deals with each of those four pillars. My output is a combination of that research and what I think it means for markets, and a portfolio which I manage that specifically is my best portfolio of ideas that I hold myself and an investor holds me accountable to, that represent those ideas, so that I have something. A lot of strategists say markets are going up or markets are going down, or an economist say inflation's going up or down, but they don't connect that to, so what would you trade? And so that's my business model. And I want to come back to that, but I'll line up the clients. I have macro hedge funds. I have long-only investors who use my work to actively weight their portfolio. I've been doing this since 2019. And in the last year and a half, I've begun to speak about these topics and broadcast my framework broadly, and also dig into very narrow, interesting things I see in markets, like barrier options in Japan triggering, or specifics on an individual company or a credit or anything that might be interesting to my readership. And I have a voice that seems to be mostly educational, but with some views that seems to have caught on. And I've built about a reasonable following, about 45,000 people on Twitter, and love that community. Interact with people like you and 25 to 30 other important people in the markets who I never would have interacted with in my life. I have a big network, but I'm interacting with people I never thought I'd interact with, and having good conversations in front of a wide audience for their benefit and for my learning. And so that's been a real blessing. It's also generated a lot of people who want more from me. And so I've established a membership model for those who want access to my research at a deeper level and have one-on-one conversations with me in a smaller forum. And so that's the Damp Spring product that's available at dampspring.com. And that's been a blessing too. It's been just the people I've met, the people I've helped have been great. An institutional business, a small money management activity, a hedge fund research providing business, and this new influencer world that really is caught on throughout the world in all manner of topics. But what I'm mostly providing for my smaller clients is education.
Well, I think one of the things about today's markets that I think is pretty difficult to argue with is it's a proposition that needs to come with a warning label. There are just minefields left and right. There are tipping points and things that can go wrong. You mentioned the incredible event really post the pandemic. It really happened in April, this USO rolling those front month futures. Who would have thought that this product could have gotten so big at the wrong time to actually take delivery and drive this thing momentarily, but to minus 35 or 37? These are the types of things that it's difficult to really know. In terms of tipping points, things that matter, let's say, to your framework, insofar as, let's just say that the base asset for most people is something akin to the S&P 500. That's where most of the equity wealth is. And so we know that problems that originate outside of this country, the US, and outside of the equity asset class can spill back into equities. You mentioned Japan and barrier options is something you're following. Is that something that you look at very closely in terms of the BOJ and it trying to hold the line? Tell us how that makes its way into your process. Is it something that you've got your eye on carefully for a potential spillover event? How does what's happening in Japan work for you?
I don't want to point at that level to Japan as a tipping point event. I just don't think it matters as much as the broader context of what's happened since the pandemic. So let me talk at that level. I'll come back to that point. But I think the reason why the current market is so difficult is because of what I think is unprecedented. The shutting down of an economy and the fiscal and monetary response was simply larger than, by at least an order of magnitude, possibly 2 orders of magnitude, of what the world had ever expected. The only thing that I think can even slightly look like it, and it's not even close, is when we went off the gold standard in 71. And thus, looking at back data, looking at past recessions, how they've worked, looking at past inflationary periods and how they've worked, I think you can learn from them, but I don't think we really have a data set that looks like what we're experiencing now. And I think that's an important takeaway. It speaks to how much risk you want to take broadly. But coming to the actual event, the thing that happened was this fiscal input, handing 3 plus, I think it ended up to be $6 trillion to the economy in the United States, not handing adequate amounts in Japan, not handing adequate amounts probably in Europe too, but handing certainly in excess of adequate amounts in the United States from the fiscal side to the people's wallets has resulted in this inflationary pressure. It wasn't the QE. That helped in terms of causing the inflation of assets, but we've had successful QE from '08 till 2018 that succeeded in generating asset inflation, but didn't generate goods and services inflation. The goods and services inflation was only weakly impacted by some wealth effect of asset inflation. This inflation is unusual. This is people being handed money, literal helicopter money. It arrived via electronic transfer into your bank account, but by and large helicopter money. And so that unwind is just highly unusual. So we'll see how that plays out. And the Fed is doing everything it can to kill demand. You then had all of the supply issues, which I won't go into because too much has been said about it and I have too much else to discuss. But the monetary tightening of QT is asset deflationary. And I noticed this on December 15th when Powell first mentioned the balance sheet and tweeted out that it was a game changer. And later in December 29 said in my report, the damp spring report, the drumbeat of QT, that January was going to be the high for asset prices. I fought it all the way down in my actual trading account, much to my chagrin. But the asset deflation of QT has so dominated the asset inflation since the April of 2000 caused by QE, the asset deflation caused by QT since the minutes came out in January and everyone woke up finally to these drumbeats, has been the dominant force for all financial assets and continues to dominate financial assets. The economy, whether it's inflationary, whether a recession is going to be created by rate hikes, how margins will be handled by high top-line inflation and lagging wage growth, how all that'll play out really is important for choosing assets, whether you want bonds, tips, commodities, gold, equities. Choosing those really depends on your inflation and your growth outlook. And I think that's certainly in play in markets every day. And I think we'll see how that plays out. But what has been key for the last 6 months is this risk premium expansion due to quantitative tightening front running, not quantitative tightening itself. That only started this month, but quantitative tightening front running. And so that's my overall framework. And now the question is, what is the economic outlook? And is there any change in the outlook for risk premiums? So that helps you decide whether you want to own assets at all or be short assets. And then which assets is going to depend on what I think are more predictable changes in inflation and growth that are really the bailiwick of central banks and regular economy workings, more normal stuff. So anyway, that's my overall framework. I think we've had the big tipping point to me happened after the CPI number, and we saw highs in 2-year notes, radical moves in 2-year notes to 342 on the 2-year, big changes in expectations of Fed hiking from sort of a 2.25, 2.5 terminal to a 3.25, 3.5 terminal all at once. And we got through that. And so I think that particular event was the most important macroeconomic event we've had regarding the central banks. And I think we're through that. The question that has to be asked now is, we are almost certainly already in a recession. The NBER may not call it that, but we've had a 1.5% negative growth in Q1. We are bouncing along zero regarding GDP now estimates for Q2. It's possible we have a negative print in Q2. So we're in a recession. You can call it whatever you want. We're in a major slowdown. And markets have priced for that. And now it's really a question of whether inflation will respond to this tightening. And so my view regarding another oh shit moment where the Fed has to radically uptick its hike plan from the 2.5 to 3.5 that they just did, from 3.5 to 4.5, I think will take a significant amount of time before that event. It may happen. I don't know whether inflation will come down or not. I think it will. It may happen. But I think we'll have to see significant numbers of data before we have another radical tightening of hikes expectation. And so I'm getting to a point where I think we're in a range of a world in which we have 1% GDP growth on a real basis and declining maybe 4% inflation. And the market's priced like 0% growth and 5% inflation. And that makes me think we have potential for more downside, but also think we're now at a point where values of all assets are stabilizing. And then it comes to QT. QT has just started. Powell made some weird comments last week about it only being $2.5 to $3 trillion of balance sheet reduction. That was less than my estimate, so I was a little surprised to hear that. But what happens, and I've said this in a number of my written work and some other podcasts, the important thing of QT, the Fed isn't selling their bonds. They're letting them mature. What's important is the Treasury has to issue to fund that maturity. And this unusual environment where nominal GDP is actually very, very high is resulting in every day our deficit is declining. I believe we're still at the margin generating a daily deficit that needs to be financed, but versus the trillion that the CBO estimated for the increase in the national debt a year ago, that number is going to be dramatically lower because tax revenues, as I said, are nominal and our spending is in gridlock. And so our need to finance a growing budget deficit is shrinking rapidly. And so the capacity that the Treasury now has to issue government bonds, they don't have to fund a deficit. So they can just fund the Treasury, the Fed maturities, which significantly reduces the impact of QT. And yet, every measure of risk premiums that I look at shows risk premiums at their widest post-crisis. And so you have to ask yourself in the months to come, is the government going to be issuing more debt than expected or less debt than expected? Because if they're issuing less debt than expected, they're going to easily be able to mute the impact of QT. Lastly, we have $2 trillion of money stuck in the RRP, reverse repo program at the Fed, which wants to finance the government through bills. They want to give the U.S. government bills, but the U.S. government won't issue them. It's pent-up liquidity that the U.S. government, if for some reason they do want to reduce the amount of coupons that they issue, and they've been doing that every quarter slowly, they can tap that liquidity and fund the government. And so that's another lever that can mute the impact of quantitative tightening. And so those are the things I'm paying attention to.
You're in the guts of the system there, trying to assess the QT. And I think it's an open question as to what the impact is. I keep asking myself, just in terms of the rate shock part. You mentioned mortgages. We were talking about 1994. I mean, there are some really interesting statistics at the margin just to consider in terms of the increase in rates and what they effectively do for housing affordability. If people are solving for what's my monthly payment, well, that monthly payment is arrived at now with a much smaller house. So in some ways, you either got to pay up for the house you wanted and pay more, or you just have to buy a smaller house if you want the same payment. So I think that's interesting. And then the other thing I just wanted you to kind of weigh in on is there's some element here where I'm trying to think forward and use the financial crisis as some analog, because as you'll well recall, the period leading into that was one of incredibly muted vol. We just got used to it. There was so much built up on the presupposition of stability in basically every asset class. And in some ways, our distribution of what was possible got really impacted by those, call it 4 or 5 years. Post 9/11, post the telco bust in 2002, you had this 5-year stretch that got the VIX to 10. And it was this global phenomenon of low vol. And then post the financial crisis, you had this incredibly long period of really, really muted rates, culminating with the pandemic itself. No one would have expected that. But even as of last August, the 10-year was yielding 1.15%. It's a remarkable number, especially set against where the inflation was. And so what I'm asking myself is, in terms of corporate America and its reliance almost as a expectation of incredibly cheap cost of funds, have we been built up in an era of such opportunity in terms of cheap funding that the adjustment, we can't really appreciate where it's going? EPS estimates for 2023, I don't know how seriously the market takes those, but they're unchanged. It's all been the multiple that's reacted. That's what you're saying in terms of risk premium. And so I think it's just an open question as to how well corporate America is going to do in an environment if rates do sustain themselves at much higher levels, rates and credit spreads. It's kind of a double whammy. How does that translate into profitability in terms of margins for corporate America?
I have a different take than most on this topic. So I consider the level of rates and credit spreads to be important. Obviously, it makes a difference to people who are buying a house that they have to pay more for the house in terms of their carry. And that should have an impact on the discount rate. And the discount rate discounts that to the present value of the house. And so the market price does matter what the levels are. But a company that can afford to pay a 10% corporate bond rate will borrow at 10% because they expect to make a margin at 10%. Similarly, they will borrow at 5% if they can expect to make a margin at 5%. They won't borrow at 5% if they can't make a margin at 5%. And yet they will borrow at 10% when they can. And why you can make a margin has more to do with whether the cost of borrowing is cheap relative to the conditions, meaning money is easy, than the level. I look at Japan, which has had, without, I guess, Europe lately, but without a question, the cheapest money around. Companies are not being formed to take advantage of the cheap money in Japan. Assets aren't being levered up. It's supposedly cheap. It's negative. It's got a zero return. You should be able to make a margin at zero. But the reason is it needs to be negative too, because the economy in Japan is shrinking. Its population is aging. It's those who do have jobs take care of the older people and don't invest in building the economy. There's a demographic in which you can't make a margin at negative interest rates. That means the negative interest rate isn't negative enough. And so similarly, a 10% interest rate may seem high, but not if the economy is growing at a point where everybody wants to borrow because they can create businesses that can generate 15% returns. And so now we're in a period of time where we're moving from one level of interest rates to another level of interest rates. And it's important to know whether that move is behind the growth, nominal growth in this case, and thus money is still easy at higher rates, or ahead of the nominal growth in which money is now tight. And that is much more important to me. And I will assure you, though no one wants to pay higher corporate bond rates, they will if there's money in it. And so I think that's the takeaway that one has to do. And obviously, higher rates mean lower asset prices. Why? Because the discount rate's higher. But if at the same time higher rates means being driven by higher growth, the growth generates higher earnings. And so, listen, what's exactly happening at this very moment is we're in a transition phase between that we don't know the outcome, which is inflation is broadly anchored at longer term maturities. If it becomes unanchored, we're going to be in a period of time where the Fed and other central banks make money tighter. Will it be still tight? Rates will be higher, levels will be higher. But will it be tight enough to kill inflation? We'll see. But it's just, in my view, nonsensical when nobody wants to borrow and we think money is tight. It's when everybody wants to borrow that money gets tight.
Let's finish this conversation with what you're in the lab working on, things that have piqued your interest. You've got a tremendous curiosity for markets. What are the things that you can share with us that are on the to-do list of projects to investigate or things you want to look at more closely? Anything that you're excited about that you can share with us?
I come back to beta and great long-term investing. And I believe that to have great long-term investing, you need to balance against an unknown future. I've read Harry Brown's Inflation Proofing Your Portfolio from the late 70s, early 80s. I've worked at Bridgewater with all weather. I get the idea of thoughtful investing long-term in beta. And I still look at most of the developed world and believe that their asset markets are unbalanced and thus not suitable as an investment for beta. And the reason why is they do not have enough high-yielding assets that are anti-growth, meaning high enough yielding government bonds. The U.S. does, the U.K. a little bit, but the rest of the world really doesn't. And until they do, there's an imbalance in the global portfolio toward anti-growth. And so my work is mostly trying to get comfortable with China, number one, as a place to invest, because they have both high-yielding government bonds and a equity market, but have all of these other constraints associated with investing there. And trying to broaden out the Dap Spring beta portfolio to include countries and regions and currencies that provide the pretty much standalone U.S. portfolio with additional diversification, which has an implication particularly as you think about things like bifurcation of reserve currency status. You want some of that diversification. Unfortunately, it still comes with a cost because the Chinese markets are manipulated at some basic level and rules change. The rule of law isn't what it is. So adding some diversification to those types of regions, China in particular, is the work I'm doing most at the moment.
Outstanding. We can leave it there and wanted to say thank you. It's been a pleasure to reconnect. It's been great to have this chat and to hear your insights. I'm sure our listeners will appreciate your time.
Thanks, Dan. It was a lot of fun.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.